Hey, welcome back, options traders. Happy Monday to everyone. And this video comes to us as a special request from one of our traders asking about really an extension of a video I did a number of years ago. I think it was 3 or 4 years ago, talking about hedging straddles. And I was just showing how you can use vertical spreads to move that V part of the risk graph as the stock price changes. But he said you didn't really go into how to close it. And that's true. I was just showing that one concept. So this is really more part two. It's an extension of that previous one. We're going to do a little bit of an overview, a little bit more detail, but then I'll show you just how easy it is to close these hedges. So let's get started with hedging straddles with verticals. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So the straddle, remember, this is a strategy where you are long a call and a put with the same strike. We get this V shape. This is the deltas from the call coming off in this direction. The deltas, the negative deltas, are coming up this way from the put. So this is a very high gamma position. Remember, long options, calls and puts have positive gamma. So when you double up on them, you're getting a lot of gamma. So typically, the straddle is used when you are looking for explosive moves, fast, aggressive moves, but you're also unsure of the direction. You think it could be up, it could be down, probably just very volatile, and a lot of back and forth. So when you start the straddle, usually, unless you want to take a delta lean, we usually start the straddle at the current stock price. Now, of course, it's going to be hard in the real world to get exactly the current stock price, so most of the time you're going to have to take a little bit of a lean. So in other words, if the stock is actually at 101 right now, you're on this side of the graph, which means that you actually have a tiny bit of positive delta. But in a perfect world, you'd like to get it centered right there so that that V is right at the current stock price. Now, why do we want to do that? Well, remember, the premise is we don't really know which way the stock is going to go. That's why we don't want to take a lean. What we're saying is that if the stock moves up, I can make money, and if it moves down, I can make money. The trade-off is I need it to be fast and aggressive. So here's the big problem for straddle traders. And anybody who thinks the straddle is the be-all, end-all, easy money game because you can make money if the stock rises or falls, you've never traded a straddle. That is definitely not true. It's got to be fast and aggressive. So here's the frustration that traders run into when they're trading straddles. They start it here with the stock at the strikes, and then maybe let's say the stock moves up. So we're moving up on this side. And yes, we have our long call to pick up these positive deltas. Stock moves up some more. We're going, hey, this is great. I'm starting to get closer to my break evens. Stock moves up some more. Now we're thinking we're just about to go positive, and then what happens? Murphy's Law kicks in, and now the stock retraces a little bit. And then it retraces some more, and you're kind of right back to where you started. Takes a big fall. Now you're on this side, and now you're generating negative deltas. You're going, hey, this is great. My long put is now starting to go into the money and starting to approach break even. The stock falls some more. We're down here. And what happens? This just goes back and forth with the stock oscillating in here, and yet the position is decaying for all stock prices between these break evens at expiration. So you can see if we paid $10 for this straddle, right there is our maximum loss, our break evens are 10 points wide. That's the 100 strike plus 10 up here at 110 and a $100 strike minus 10 down here at 90. We need the stock to be either below 90 or above 110 at expiration to start making money. So a hedge that a lot of traders would like to do is to keep this bend, the strikes right here, lined up with the current stock price. So if we could keep this moving with the stock price, we're always going to be ready to capture on either the positive or the negative deltas. So if you can keep the stock lined up right here at that strike, you're always ready to either capture positive deltas or negative deltas as that stock moves. So that would be pretty cool if we could always move this straddle with the stock. So how do we do that? Well, that's where hedging with vertical spreads comes into play. It's not the only way to do it, but it's a very common one and very powerful. So here's the way that it works. So let's say for the straddle, in the example was 100 straddle, we are long $100 call, so we're going to put a 1 under the plus sign here. We're long 100 call, and we are long a $100 put. So that is a long straddle. And then let's say that the stock moves up to 105. What you're going to do for this hedge is you're going to double up on the spreads. If you're long one straddle, you will sell two spreads. If you're long two, you will sell four, and so on. So because we're long one straddle, we're going to sell two vertical spreads. Now I'm saying sell because I'm on the call side. If I wanted to do puts, I could do that as well, but I would have to buy them. And there's nothing wrong with that. Credits are debits, debits are credits, calls are puts, puts are calls. But what I typically do is to stay on one side of the board. Otherwise, it can get a little messy to track. So for right now, I'm just going to use calls, but take your pick. You could use either side of the board. So if I'm going to follow the stock coming up to 105, I would need to sell two $100 calls and buy two 105 calls. So again, as a recap, we're long one straddle. I'm selling off twice as many vertical spreads. So notice what happens when I do this. The 1 and the 2 right here net out to give me one short over here. So once that trade executes, you're just going to have one short $100 call and a long put. And what is that? Most of you know from your synthetics, that is a synthetic short stock position. So visualize it, if we're short 100 shares of stock and then we buy two calls, that's also going to give us a straddle. And you'll see why in a moment, but we are just synthetically creating the straddle, but we're doing it at 105. So here's what's happening, and this is why we would sell the vertical spreads as the stock is going up. As the stock is going up, think positive deltas. My hedge is I want negative deltas. So once I realize I need a vertical spread with negative deltas here in the center, I could buy the put spread, I could sell the call spread. Now notice at expiration I have 0 deltas for all stock prices below 100, and I have 0 deltas for all stock prices above 105. So that's not going to interfere with my straddle. But what is going to affect it are these negative deltas right here, but they're only between 100 and 105. Now remember, we're selling off this spread twice. So I actually have 200 deltas, or technically negative 200 deltas between the strikes. All right, so what's that doing for us? Well, take a look at the spreads. We're going to break them up. Instead of looking at two 100, 105 verticals, we're going to look at two short $100 calls and two long 105 calls. All right, we're just breaking them up. So here is our straddle. Now the stock is moving up on this leg over here, which are the positive deltas. When I sell the first call, let's just break them up. So if I look at that individually, if I sell that first call, I'm just getting rid of this leg over here. I'm just selling the call. What does that do? Well, that's going to leave me a long put. Remember, I'm long a put and long a call. So if I sell that call, I just have the long 100 put. Now, let's sell off the second call. When I do that, what happens? Well, I'm going from no call to a short call. And so what is the combination of a long put and a short call? There's your synthetic short stock position. Now let's look at this long 105. If we buy the 105 call, that is going to give us an insurance policy right here at 105. So now I'm going to go from having these unlimited negative deltas in this direction to flat. At 105, I'm right back into my synthetic put. Short stock plus a long call. Now let's buy our last call over here. What happens? Well, now I go back to positive deltas, and that's what lifts this side up, and we can see that we are now centered. Here's our graph. Forget about this little red tail down here. There's our graph, that V, and we are centered right there at 105. So you can see that selling two of the 100, 105 vertical spreads has just recentered us at this strike. Now, once again, I could do the same thing by buying the 100-105 put spread. They give you the same risk graph. I would just stick to one side of the board just to keep things clean, either the calls or the puts. So now what happens? Well, here's our original position. And when I sell the two spreads, what I'm going to do is to recenter at 105, but on a net basis, I'm generating credits. So notice that this red curve is shifted a little higher. I've reduced the risk. All right, so let's say that the stock continues to climb from 105 to 110. What do we do now? Same thing. We're going to sell two vertical spreads. Why two? Because the initial straddle was 1. So from this point forward, we're just going to be selling two of these spreads. But now I'm going to sell the 105, 110. So let's sell two of the 105 calls and buy two of the 110s. Look what happens now. These two right here cancel out, they're gone, and we still have our synthetic short matched with two 110 calls. So now you should be able to visualize we've got that synthetic short stock position, but at the 110 strike we're now going to bend, so it's going to look like a straddle at 110. But as you'll see in a moment, because of these credits that we're getting from selling off two spreads, we're just walking that vertical spread up. So now I'm going to go from the red line at 105 to the blue line at 110. And as we continue to do this, we will eventually, hopefully, walk this straddle above zero. Now, as you'll see in a moment, what if the stock falls? We're going to do the same thing in reverse. And so if it turns around and starts to fall, we will still shift this curve higher, but we'll just come back to 105 and then to 100 and so on, always working to shift this curve higher. And that way your stock is always right there at the strike, ready to capture those positive or negative deltas, but we're also sweeping off some credits to reduce that maximum loss. So let's look a little further at what's going on here. Here's the initial straddle at 100. When you sell off two of the 100-105 spreads, this was our first hedge. Take a look at what happens. When the stock goes from 100 to 105, this part of the risk graph picked up 5 points. It's one straddle. You've got one call here. So you picked up 5 points. Remember, these are expiration risk graphs, but the math is still going to work out in a similar way. But right now at expiration, we've picked up 5 points. But take a look at our spread. Now remember, these deltas here are 200 deltas. We can see they're a little steeper than they are over here. So what happens is that we picked up 5 points here. If we sold this spread for $4 each, which it looks like we've sold right there for $4, that's another $8. So 5 plus 8 is 13, but we owe 10. Don't ever forget that on a credit spread, it's a liability. So we owe back the $5 difference times 2 or 10. So if we've collected 13 and we owe 10, we're up 3. And so this risk graph should slide up from minus 10 to minus 7 right there, but lined up at 105. So that's kind of a closer look at what's going on with your deltas and why that is shifting higher. All right, so the main question that this trader was asking, well, how do we close this thing? Now I've got this short stock position with the stock going up. Well, it doesn't matter. Let's say the stock rises to 120. We sold off two vertical spreads, let's say at $4 each or $8 total. So we've collected 3 rolls, going from 100 to 105 is one roll, to 110 is a second, to 115 is a third, to 120 is a fourth. Those are 4 different rolls where we, on a net basis, shifted by $3, as we just saw. So we've collected $12, but we paid $10 for the straddle. So we have a net guaranteed gain of 2. So the idea is, how do we close out the short position? Well, it's from the credit of all of those rolls. But this is why you have to be careful, which is true for all rolls, that you're not rolling just for the sake of a credit. Now there's another view. We can come up to the same answer. We've collected $32 total. I got $8 on 4 rolls. So I've got $32 sitting in my money market, but I'm going to owe how much? Remember, the stock is at 120. We're short synthetically short at 100. That's 20 bucks that we owe. So if I've collected $32, but I owe 20 on the synthetic short stock position, that's $12. And because I paid 10, there's my net guarantee of 2. So once you're looking at your position in your broker's platform, you're going to see something like this. You're going to see the short position up here, synthetic. Now with the stock at 120, this put's worthless. It's basically not even there. So it has no value. We can just kind of ignore it for now, but it's not going to cost us anything to buy it back. But this short call has got 20 points of intrinsic value. So where are we going to get the 20 points? Well, you've got $32 from your rolls. And then plus, if there's any extrinsic value here on your long 2 calls, so you just unwind it. All you'd have to do is close these 3 positions. There's just going to be 3 of them. All right, so that's if the stock price rises. What if the stock price falls? This is what starts to throw people. They all want to switch to the puts. And again, you can, but you can do it with calls as well. The trick is to realize that when the stock is falling, you're dealing with negative deltas. And now to hedge it, we need positive deltas. So I either need to buy the call spreads or sell the put spreads. So here we're going to buy 2 call spreads, again, assuming we started off with 1 straddle, or you could sell 2 put spreads. Same thing. We're trying to put positive deltas into the picture. So here's our initial straddle in black. If I buy, let's say, the 95-100 vertical spread twice, that's the risk graph in red. So notice that we are buying the 95-100 because the stock has now fallen to 95. So now let's just follow the deltas. Let's say that the stock is down here at 95, so these are going to be relatively cheap spreads. They're out of the money. So let's say we pay $2 each for them. That's going to be a total of 4. Well, when the stock falls from 100 to 95, you've picked up 5, but now you've spent 4, so that's going to shift this risk graph up by 1. You're going to go from minus 10 to minus 9. Now, sometimes traders get thrown and they say, wait a minute, when the stock fell from 100 to 95, you were also on these negative deltas up here times 2. No, you weren't. When the stock fell from 100 to 95, you just had the straddle. This red line came on after the stock fell down here to 95. So that's after the fact. So these negative deltas are not affecting you. So I know it can get confusing. My best advice is to practice with it in a platform, something like Thinkorswim. But for right now, let's go over to an Excel spreadsheet and see if these numbers actually hold true. Okay, so now we're into an Excel spreadsheet. This is from Macro Option. I've talked about this in a few of the videos. It's just macrooption.com. He sells all kinds of different spreadsheets, lots of them with pricing models. It's a one-time fee, but it's a really cool spreadsheet. Takes a little bit of getting used to, but it's very easy to use. So let's just say that we have 1 call and 1 put. Notice I've selected call and put, $100 strike, and I'm just going to make 10 the price for the call and 0 for the put. Mathematically, it doesn't matter. I could pay 5 and 5. The calculator doesn't know. So I'm just doing that to make it easy. So we're paying $10 for the straddle. And you can see that right here the V lines up at 100 and we're lined up at minus 10. Now let's put on our vertical spread. Let's say that the stock goes up here to 105. So remember what we're going to do. We are going to sell a call and buy a call. At least that's what we did in the presentation. So over here I've got minus 2. We're selling the 100 call. We're buying 2 of the 105 calls. That's those 2 right there. And again, I'm just trying to make it easy. I'm going to say I'm going to get $4 a piece for them. Remember, they're in the money. And so we're getting $4 each times 2, which would be 8. So I'm just saying we're getting $4 for each of these shorts. We're paying 0. Is that realistic? No, but it doesn't matter because I could just trying to make it so that it's a net of 4 each, just to make the math easier. So we're getting $4 for each spread. And when we do that, look what happened to our risk graph. If I point right there, do you see that little white box? It says minus 7. And that's what we saw in the presentation. we shifted from minus 10 to minus 7. Why? Because I collected $8 total. $8 plus the $5 that I picked up from the positive deltas running from 100 to 105 is 13. I owe back 10. Don't forget that. This is a short spread. 5 points wide times 2. I owe 10. So that's a net of 3. And that's why we've shifted $3 higher. So now ask yourself, what if we had sold these for $3 each? Well, we would get a total of 6 plus 5, which is 11. We would owe back 10. We should shift up 1. This point should be at minus 9. So let's try it. Let's go 3. And if we point right there, look at that, right there in that white box, minus 9. But we've still shifted the risk graph higher. All right, let's go the other way now. Let's go back to our initial straddle. So there we are at minus 10. Let's say the stock falls to 95. Okay, so think about what we're doing. We're on this negative delta leg right here. I need positive deltas to hedge it. So I could either buy a call spread or I could sell a put spread. In the presentation, we bought a call spread. So let's do that again. Let's make this a call and a call. We're going to buy 2 of the 95s. So let's make this the 95 strike right there, and we'll make this the 100. We're going to buy 2 and then sell 2. And if we do that, we should shift up by how much? Now think about it. The stock has fallen 5. We picked up 5 points from our short deltas, but now we've spent 6. See, if that's true, we should be worse off by $1. We should be at negative 11. Let's go check. So if we come down here, there you go. See that negative 11? So we really wouldn't want to buy these for 3. We're trying to buy them for less. Keep in mind, some time has gone by. We're buying the at the money. They're going to be cheaper than $2.50 because the stock is below the halfway point. They will absolutely be less than $2.50. So let's just make them $2. That's what I did in the presentation. Now think about it. You picked up $5 as the stock fell from 100 to 95, and then after the fact, you spent 4. So on a net basis, you've collected 1. Do we owe anything back here? No, this is an asset spread. It's a debit spread. So we don't owe the difference in strikes times 2. So now we should be shifted up by $1, and we should be at minus 9. Let's go check it. We come down here, and there it is, showing you minus 9. So we could just keep doing this. If the stock falls to 90, we buy the 90-95 call spread. For certainly less than $2.50, we will shift higher. And so that's really the basic idea. And then when it's all over and done, you've got the 2 positions up front, which was your synthetic short position. And then you just have your remaining 2 calls from the spread to close, or if you use puts, the remaining 2 puts. And if you've got, let's say to the downside, maybe the stock has fallen to 85, remember you're short at 100. You've got that 100 put. You've got a box in here. So you've got 15 points right there. If you're on the high side, like we saw with the stock at 120, you owe the 20 points, but you've also pocketed those differences from the sale of those spreads. It all works out mathematically. So I hope that helps to answer this trader's question. And as always, if you have other questions, please post them. I appreciate any suggestions for videos, by the way. I always want to know what people are trying to learn and happy to help with that. But this is a little bit more of an advanced hedging strategy, but one of the things that I really like about it, it shows that there is almost always a way to make yourself better off by using options. So if you're trying to avoid this back and forth whipsawing that so often occurs with straddles, by recentering that point on the straddle but collecting cash over time using vertical spreads is a very cool way to do it, and I hope it now makes a little more sense. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new Greeks class for 2025. There's also a candlesticks and technical analysis course. It's all at optionsA2Z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.